everybody. Welcome to another episode of the Notorious Pod. I think this is going to be another Musings because I'm alone. But that's okay. It's a lovely Monday morning when I'm recording this, and it's sunny and it's bright, which is an exact contrast, I think, to the topic that I want to discuss. So a couple of days ago, last week, I wrote a VIP post titled, "Maybe the housing market will collapse after all." And there was some pushback on Twitter and social media, just like, "Rawr, you don't know what you're talking about. It's clickbait." And I'm like, "You didn't read it, did you?" And in fact, I know he didn't read it because he's not a VIP subscriber. I think whoever was thinking that I was suggesting that housing price is going to collapse. That's actually not what I said. I was pointing to a very specific thing, which we're going to get into later here, which is about sort of government hearings at the Senate, and how the only thing that could crash the housing market is probably stupid regulation. And in my opinion, most regulations are pretty stupid. So I thought that's the only real danger. But that was in my mind when I saw this this newsletter that I'm subscribed to. Let me pull it up and share it with y'all. All right. So I'm subscribed to this newsletter. It's a WordPress website called Confounded Interest. And I can't remember how I found it. I ran across it. It's written by some anonymous person. Let me zoom in a little bit. And I wish I knew how to get a hold of her, because I would love to get him on a podcast and discuss a lot of things. I think he and I are very similar in terms of kind of where we see things, our take on, on the economy, on the housing market, on, financial markets and all of that, right? But here's the headline from today. Simply unaffordable: how the Federal Reserve and federal government are making housing unaffordable for millions. Rents growing at 18%, home prices growing at 19%, real wages growing at negative 1.8%, meaning it's not growing, it's actually shrinking. So let's go through it real quick. Again, I strongly recommend, if you're interested in this sort of, doom scenario type stuff, Confounded Interest might be a good website for you to check out. Maybe subscribe and follow along. But what he points out is in January 2020, right? So before the pandemic, right? The home price index was going 4% year over year, which it's healthy, right? I mean, it's above the sort of long-term average for housing, which is around, 1.5%. It's going up 4% a year. The Zillow rent index was growing at 2.9% a year, and real average earnings, hourly earnings, were going up at 0.5% a year over year, right? So that's, wage growth minus inflation, minus CPI. Okay. As he points out, today, the U.S. has home prices growing at 18.8% rate, rents growing at 14.9%, and real earnings growing at negative 1.8%. And he's got this wonderful chart. I think whoever writes Confounded Interest likely works in finance, likely is an analyst of some sort, because I think this is Bloomberg Terminal, and he's really good at putting these charts together. It's really, really cool. Excuse me. But as you can see, I mean, everything is up and to the right, except for real wage growth, except for real average hourly earnings year over year. I mean, as you can see, it's really plummeted and it's negative. Meanwhile, various index, the Case-Shiller rental index, Zillow rent index, up and to the right. Okay, now, and he talks about, the national rent index up 18% if you go by apartment list. So Zillow says about 15%, apartment list saying 18%. Here's the thing I found interesting. Okay. So cities with the fastest and slowest year-over-year rent growth, right? And I think what most people, are going to pay attention to are, these cities kind of, New York, Tampa, Scottsdale, Orlando, right, where it's like 30% year-over-year rent growth, which is insane. I mean, it's, if you're in these markets, tell me what's going on, right? But it's sort of the ones that we would imagine, right? Tampa, Scottsdale, Orlando, Mesa, Arizona, St. Petersburg, Florida, Phoenix, Arizona, Glendale, North Las Vegas. Las Vegas, Henderson, and I live in Las Vegas, and I know it's like, yeah, 27, 26% rental increase year over year. What I looked at, and I thought was interesting, was on the other column, slowest growth, right? So the slowest growth, okay, we have Oakland at 0.5%. Don't know what's going on there. Detroit 2.6, Minneapolis. But then, you get to like St. Louis, right? So this is seventh. So it's the seventh slowest growth year over year in rent, and went up 7.1%. And I'm going, wages didn't go up 7.1%. As we saw, wages actually went down about 2%, 1.8%. Real wages, right? So, wages, less inflation. And yet, even in the slowest growing rental markets, we're at 7.1%. Norfolk, Virginia, Lubbock, Texas, 8.6, 8.8. Like, did the people who work in Lubbock, Texas see their incomes go up by 8.8%? I don't think so. So, yeah, in comparison to, Phoenix, comparison to Tampa, that looks like, oh, wow, okay, that's pretty decent. I'm like, I don't think it's decent at all. That's pretty horrible. Even in the slowest rental growth markets, we're up almost double-digit percentage. Meanwhile, wage growth is low, right? It's actually dropped. So I thought about this because obviously he's blaming the Fed and the federal government. And I think it's something that people, I don't know, I think we get it, but we don't get it, right? It's macroeconomics is boring as hell. It's really hard to kind of pay attention. All we see are sort of the top line, like, oh my God, Fed printed all this money and therefore inflation nation. Yeah, I mean, that's not a bad way of looking at it, but I did think it's worth kind of looking at how this works and how serious, this potentially is, and why I think I've been maintaining for a long time. There is no real estate bubble. The real estate bubble won't burst. The housing market's not going to collapse. I think we're going to see, double digit, maybe 18, 20% year over year price appreciation for homes, 14, 15% rent increases, like for the foreseeable future. And a big part of it is because of some of these guys that I follow, way smarter than I am, much more of a financial analyst. And one of my favorites is this gentleman, Luke Gromen, for Forest for the Trees. And he was on a podcast, and this is a transcript. And I'll see if I could link, the podcast and transcript everything in the show notes below. But he and Daniel Scrivener, who's the host of the podcast, sort of got into this conversation. I've heard Luke talk about inflation and sort of the federal fiscal versus monetary before. And I think it's worth at least looking at, right? At least talking about very briefly. We might have to do something much bigger later. But his point is you can always generate inflation, right? Because it's easy. And this was such a great example. So I just wanted to talk about it. If the government came out and handed us all $1 billion each, and then issued however, many quadrillions or quintillions of dollars of debt to offset it in order to give us that money, then the Fed buys all of that debt, then we're going to have inflation, right? And his point is like, it's obvious if we think in terms of like really big numbers, right? Like if the federal government said, okay, here's, stimmy checks, right? Stimmy checks now 2, and everyone's going to get $1 billion. Well, clearly we would overnight, like everything would just go up immensely in price, because who in the world is going to sell their home for $600,000 when everyone just got $1 billion check, right? So we see that, it's obvious. So his point is like, what we really did was Fed sent a few $1,000s. I mean, I can't remember the numbers anymore, like $600 stimmy checks, but then there was PPP, there was all these other things. So the federal government, because of COVID or their shutdown of the economy, they came out and gave companies a bunch of money. And then the Fed essentially bought the debt that the Treasury issued in order to give people all this money. It's saying, look, it's a smaller scale maybe, but it's easier to understand when you do that, when you have fiscal action, when you have fiscal stimulus, it's much more immediately inflationary, right? And he talks about it here. In 2008, we still had money printing, but it didn't impact inflation as much as today. Why? Because in 2008, they just cut rates, right? They went and bought, mortgage-backed securities, et cetera. So they try to save the banks. but they didn't hand people a bunch of money to go spend. Whereas this time around, that's exactly what it is. In reality is the government spends the money, hands it out, and then they issue those bonds. So it's the other way. In the first one, they just sort of, the Fed went in and bought the bonds and supported the price, lowered rates, made it easier for banks to, to loan money out. It wasn't the direct sort of rocket fuel that the federal government printing checks and sending it to people is. And that's what we did this time around. So let me scroll down because there's some interesting things. So this is a point that, again, he's made over and over, but let's go through it again. Do I think they're understating inflation? They being the government, right? BLS, the Fed. Absolutely, I do. People say, what would you point to? I'd point to used car prices being up 65% this year. Yeah, he's right. Used car prices are up 60% this year. Home prices are up 15, 20, 25%, depending on the market, or even higher. So his point is that there's a lot to suggest inflation is way above even the nominal, like the BLS government CPI, top line CPI number, which came in at 7.5% in January. So this is a little bit old. He's talking about 6.2 in October. We know 7.5 in January. It's probably a lot higher than that in reality, because again, look at the stuff that people are buying. It's up 60%, 20%, 25%. Now, actually, I'm not going to get into this. Is a whole interesting thing we should do another video about. This is the part where I felt like, okay, absent some sort of weird, sort of government regulation, we're going to have this market we're in pretty much permanently. What he points out is back in the 70s when we had the bad old inflation days, right? We're talking about like 20% mortgage rates. Rates went super high. Inflation was crazy. We had lines at gas stations. I wasn't around then, right? I mean, I think I'm born in 71, so I was like a little baby. But, there were a number of people in real estate who were around then who remember those days. What he points out is the US debt to GDP was 25%. The last time we had, this incredible inflation in the 70s. Demographics, we were a much younger country on average, much more industrial, right? Much less financialized. So his point is in the 70s when we had all this inflation, and then Volcker and Reagan, they'd come in and raise rates like crazy, cause a couple of recessions in order to drive, tame inflation. Our economy wasn't as sensitive to interest rates. Today, that's not the case. Today, we have debt to GDP of 125%. We're much more financialized. We don't really have a whole lot of industrial, sort of sectors of the economy anymore. Like, this is the thing that people complain about. We've outsourced manufacturing to China, whatever, right? And now we have an economy that is much more sensitive to rates. And we have tax receipts that are much more sensitive to rates, because obviously people are going to pay taxes based on things like capital gains as opposed to just income, right? And as a result, he doesn't think that they could raise rates. And here's why. And this is a point I think I've made in previous posts, but it's worth kind of looking at over and over again. So the Fed plus the federal government, so the two of them together, because they are separate, but they're obviously working kind of in concert. They're in a real tough place, right? Because here's what he says. I'll just read it to you. And that's the point, where either you tell baby boomers, sorry, we can't pay you everything we promised you. It's like Social Security, Medicare, etc. Or you default on treasuries, which is like end of the world type scenarios financially, or you slash other treasury spending, meaning, actual spending by the federal government, which you can't do because they're helping support the economy, or you have the Fed print the difference, right? And I think it's obvious what he think, will happen. The Fed's going to print the difference. So you have to decide, are they, the Fed, going to let rates rise and blow everything up? Or are they going to go through periods where they threaten to let rates rise, which is what Powell and the Federal Reserve have been doing so far, sort of talk it down, right? And then see what really happens. And his view is that ultimately you have to have, like negative real interest rates in order to inflate the debt away, because our debt to GDP is just way out of control. Now, boring macroeconomics, I apologize. It is what it is. Why do I care about that? Why should we care? Because we saw this in the news February 16th, so a few days ago, where it came out that real estate investors are buying a record share of US homes, right? So take the three. So in the piece one, we have confounded interest pointing out like home prices are up 18%, rent is up like 15%, right? Real wage is negative, okay? Real estate investors buying a record share. There are some real interesting things. So real estate investors bought a record 18.4%. That's up from 12.6% last year. And if you all remember, it's not like December 2021 was some sort of a slow month, in terms of investor activity. And here's the chart, right? So it seemed to have dipped a little bit kind of at the beginning of the year and then went right back up. I think that's sort of seasonal. But as I was going through this Redfin report, one of the things I found interesting was this one. We define an investor as any institution or business that purchases residential real estate, which means these numbers are excluding families, individuals buying a second home as investment property. If we add that in, maybe the real number is significantly higher than 18%. And there's some reason to think that that might be what's happening, and I'll go through that. Look at these numbers. Investors bought 80,293 homes in fourth quarter, up 44% from a year earlier. 44%, y'all. Like, clearly capital's rotating into real estate, right? But, over 3/4 paid cash, mid-priced homes. This is a really interesting report. You should go check it out. Again, I'll see if I can link every one of these that I've referenced here. One of the things I thought was like, wow, is this. The single family homes made up 3/4 of investor purchases in Q4, right? So they're not, sure, they're still interested in condos. They're interested in, apartment buildings, but really 3/4 of investors were buying single family homes, which, it has all sorts of implications, all sorts of ripple effect, like low inventory, all of that, right? But as I was looking at, okay, that's cool. Let's go down to some of the real details, right? So Redfin looked at some of the highest sort of, investor activity metro areas. And I don't think this would be surprising to anybody, any of us in the industry or anybody kind of in those markets. Atlanta, Georgia, number one, 32.7%. And that's an increase of 75% year over year. Makes perfect sense, right? Atlanta is one of the hottest markets, especially for investors. Might be because their median price is still low, so investors can go in and buy 1,000, of these things way easier than they could in New York, right? Charlotte, Jacksonville, Las Vegas, Phoenix, Miami, Orlando, Tampa. This is where the investor activity is happening, primarily because the homes are relatively lower priced. But boy, look at these purchases year over year. That's Jacksonville is 157% year over year. Investor activity is up 157%. That's nutty, y'all. I haven't pulled the Jacksonville, inventory numbers, but I bet it's pretty low. I can't imagine it not being. Las Vegas, I know for a fact is like what inventory, I know that for a fact. Why? Because up 105% year over year. Makes perfect sense, right? And then the question is why? Why are investors up? Why so much more interest? And I think it's because of the inflation thing, right? I think it's because, as Luke Gromen talked about, people are starting to realize, okay, we're in a situation, sure, Powell and the Fed could talk about we're going to raise rates, we're going to quantitatively tighten, etc. I think a lot of these institutions, a lot of these people, and I think I'm in this boat, are betting we're calling your bluff. We don't think the Fed's really going to carry through with this to the extent that it needs to, because if you did, the United States federal government is bankrupt and they have lots of spending plans. They have to, essentially, right? It's not like, I mean, could you imagine what happens if the government came out and said no social security payments? If they say no food stamps? Could you imagine? We would literally have rioting in the streets. There would be blood in the streets. Like, we can't have that. So they're going to supply that. Well, how are you supplying it except through borrowing the money from someone? Nobody else is giving the Fed money, so the federal government any money. So it has to be the Federal Reserve that buys those bonds. How does it buy those bonds? It creates money, buys those bonds. And that's the mechanics of it. And I think the investors are seeing that, and they're rotating out of other financial assets and going into real estate, which is a wonderful inflation hedge. We know it's a wonderful inflation hedge. Why? Because of this, right? Because of that. Home prices up 19%, rent is up 15% year over year. That's well above nominal inflation, probably pretty close to true inflation or slightly higher than that. That's the mechanics. Now, given that, why would I have said that maybe the housing market might collapse after all? And it's because of this hearing, right? So again, I wrote this in the VIP post. What is the hearing? The United States Senate Banking Committee, I think it's Banking, Housing, and Urban Affairs. I think it's kind of interesting those three are tied together, but whatever. The Senate held hearings recently, February 10th, about this, and they examined this topic, how institutional landlords are changing the housing market. Again, I mean, if you were interested, like VIP subscribers, you've read my take on all of this. I think at this point, all I can say on this end is I don't think we're going to see anything really disruptive coming out of the Senate. I don't think. But what I wrote there was, and the reason why I said maybe the housing market might collapse, if some of the more radical members of Congress decide that this is an amazing opportunity to do something like national rent control or some sort of extraordinarily punitive taxation on rental income or what have you. I mean, you could think of a bunch of things that they could do. Maybe make evictions basically impossible. Then housing can collapse, because real estate investors look at housing after such regulations and go, we can't. That is not a viable asset category. So yeah, I don't want to be in bonds where yields are negative. I don't want to be holding cash, but I'm not going to buy housing because then I'm just throwing my money away. Maybe they go into Bitcoin. Maybe they go into gold or oil or commodities or something else, right? Maybe they put all their money into Tesla stock. Who knows? But they're not going to put it into housing. If the government does something crazy, does something stupid, I don't think they're going to do anything crazy and stupid. But at the same time, man, we are talking about the government. Right? We are talking about Congress. They could do something crazy and stupid, because politically, in a midterm election year, some of those people might feel like they have to do something crazy and stupid if they want to come back to Washington, D.C. next year. That's my major concern around the housing market, and that's why I said maybe it will collapse because of this. But I think as I'm thinking about it, the point I would make is this word, right? I know politically the Senate's going to go after, and all politicians are going to go after institutional landlords, right? I get that. But there's a lot of studies suggest that institutional landlords, meaning these big hedge funds and private equity funds, et cetera, there's the BlackRocks of the world, they're really only about 2% of the market, right? In other words, there's no way institutional landlords are responsible for this much of an increase, that this type of market share of homes bought by investors. There's just no way that they're responsible for all of this, right? There just isn't. I think a lot of this investment activity is not coming from a hedge fund. It's coming from much smaller, either very wealthy families, family trusts in some cases, smaller private equity funds, maybe smaller investment LLCs. But I think a lot of this is we can't really call it retail, but there are people who might have 2 or 3 properties, right? Not 2,000. I think it is, which means that this hearing, sure, it might focus on the institutional landlords, but whatever they do, chances are they're going to have to affect most landlords. Otherwise, you can't really affect rent. Right? You can't really affect some of the finance, some of the economic numbers that we're seeing. Right. So that's kind of where I want to leave it today. Right. All of this, interesting news, and I say interesting in that ancient Chinese curse way, like may you live in interesting times. We sure are living through interesting times. I'm thinking it's a lot of that is because of the fundamental sort of macroeconomic trends, the money printing, the fiscal stimulus, not just monetary stimulus. The fiscal stimulus is causing some of these issues. It's making investors think, okay, I don't want to be in bonds. I don't want to be in equities. I want to move my money somewhere else. The best place to put that would be real estate. And they're putting it into real estate. They probably will continue to. And that suggests that even if rates go higher, the prices aren't coming down, at least drastically. Who the hell knows? I could be completely wrong, but I don't think it's coming down because what's potentially going to cause it to come down? Sure, we could talk about Fed's going to raise rates and tighten, quantitative tightening, but how long could they keep doing that? Because as Luke Gromen points out, the government's really stuck between a rock and a hard place. You either have inflation and negative real rates, like significantly, excuse me, or you have like everything blow up. Meaning like literally potentially blood on the streets because Social Security, food stamps, aid to families dependent, AFDC, like we're talking about a lot of these government programs going away because they don't have any money. I don't see any way where people allow that to happen, which means they will go and borrow the money and the Fed will have to buy those treasury bonds in order to finance that, which means more money, which means et cetera, et cetera. So I'm kind of the boat that absent government regulation, absent Congress doing something stupid, we're not going to see some collapse in home prices. We're not going to see that. At the same time, that just then sets up this hyperinflationary environment, and we're going to have other distortions. Right? And we'll see how policymakers, how the government, especially election year, handles that. So I know it's macroeconomics, I know. But we got to talk about it because it's so important, because it's driving so much of what we're seeing kind of out in the marketplace. I saw a Facebook post today talking about how in I think this was the Tri-County area near Charleston, there are only 999 homes, active listings. A year ago, there were over 2,000. Like, you want to know why? This is why, right? You want to know this is why, which means that these people, who are politicians, they're not going to just sit back and like do nothing. They have to be seen to do something. So that's why I think we need to at least pay attention to this. This is a real important thing. And I get it. Look, man, I'm not an economist, certainly not your financial advisor. So, go ask an economist, go talk to your local association, your local MLS, talk to your broker, right? And see what the trained economists have to say about that. Maybe they'll say something that's different, and they'll be much more upbeat and much more positive about how things happen. I think I'm upbeat and positive for home prices. I think I'm upbeat and positive in terms of real estate brokers and agents, at least the ones who are closing transactions. Y'all are going to do incredibly well. 2022 is going to be unbelievable. But this can't last. And these trends will somehow, we'll see what happens. But these trends cannot last. There's political gold to be made by going after some of these things. And I think that means that people are going to go after it. Let's just see what they do. Certainly, I'm going to stay on top of that. You should as well. And if you have any thoughts, any questions, let me know. Always happy to hear from y'all. All right. Thanks.